Another series of BFM. Here we are covering important theory questions, objective questions, and some numericals. So let's start without wasting the time. Uncertainty. What is uncertainty? Under uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk because there is a huge credit risk because there was huge NPAs during that COVID situation and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see, the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So, adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have Civil over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata's or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is that? Difficulty to select a healthy company from the riskier company. It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level, we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at a CIB level, it is what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So these are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether that loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing a difficulty in paying the normal rate of interest also. Okay, or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations. Means my employee errors or my system failure or my region failure, area failure. Area means what? There is a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear? Simple? Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you one question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it mutual fund? So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk, that is important. Now if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero, okay. But if I invest in mutual fund, there is the risk involved in it. So this risk factor I'll have to consider using my this other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay. Suppose if you are buying Reliance right now, Reliance share. Okay. You are buying a Reliance share at, let's say, 2500, expecting it to go up. Okay. But if it goes down, then to cover this downside potential or downside risk, what do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost, because put option doesn't come for free. So this will carry the cost. So this is known as the risk, amount of risk, and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk, to cover my risk. Okay. So this is for to cover the downside. I'll buy a put, and this put will cost me something, and this will be known as my risk capital, which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So all these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series. Right now, what are you watching right now? Free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay. Risk adjusted return on capital, RAROC. What is RAROC? Have you heard this term RAROC? Type yes in the comment section. Have you heard this term before? RAROC. Type yes in the comment section or no. Whatever. Yes or no. So it is. Yes, I've seen many of them. Yes. Okay. So risk adjusted, we have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here. It does this by accounting for any expected losses and income generated from the capital, with the assumption that the riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, RAROC. So same as this earlier, we have seen one earlier definition just now. Similar to this, higher the risk, I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So it does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment, okay. Same example. Suppose if I am investing in FD or in mutual fund. So definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So, what do you mean by this? Here, managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. Analyzing, forecasting, and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. Here, this is called as long position. Long means, suppose if I buy a Reliance share, Reliance, okay, at 2500, expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the this derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk. And this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only, okay? Short-term liabilities exceed the short-term assets. Means suppose if my liabilities mean deposits. If my bank's deposits are much more than my assets or my loans, then I'll definitely face the problem of liquidity. Means I'll be facing the problem of this interest rate risk, because the interest going out will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light on its liquidity. So immediately if there is a maturity mismatch, it will be shown in the company's balance sheet. Why? Because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I am having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, also the durations of the loans and the deposits need to be matched. Duration. Okay, that's what the maturity is says. Suppose if I am having a loan, or if I take a deposit of, let's say, deposit, okay, if I take a deposit of, let's say, 1 year, of, let's say, 1 lakh, okay, and I have to give a loan against this. So the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's the best. So 1 year, it should be, the maturity should match of deposit and loans. Okay. Market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand this word. See this. It means that if Reliance share, let's take Reliance only. I take Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share and this Reliance share now, let's say, is priced at 2500. Okay, let's say 2500. And now what happens? This Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay. So that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay, that is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer everyone. 2500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then, yeah, 25 crores. Yeah, it'll be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we need for clearing JIB and CIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of securities of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIB also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to, let's say, 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. Indicates how much the investor stands to lose, how much this investor will lose if this downside potential means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide a guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See, this guaranteed clearing over here means it is called as settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay, you sell, let's say, shares to anyone, shares, okay. So this other person, Mr. X should give you rupees, right? Rupees, because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part. Provides a guaranteed clearing and settlement function for transactions in money, government securities, forex and derivative market, right? So CCIL is okay. Tell me one more thing. This shares example which I gave you, does it take care? Does CCIL take care of the shares over here? Does CCIL take care of the risk of the shares, settlement risk of the shares? No. Then who takes care of the settlement risk of the shares which you buy and sell? Type fast in the comment section. Who takes care of the settlement risk of the shares which you buy and sell? Who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange, and derivatives market. 4 clear. Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay? Yeah. Like that, there are some things which money can't buy. For everything else, there is MasterCard. That was ad. Remember anyone? Now gone, isn't it? MasterCard was having an ad few years back that there are some things which money can buy, and for everything else there is MasterCard. Similarly over here, only share settlement risk is taken by NSE and BSE. For everything else there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise wide risk measurement or risk assessment. Enterprise wise means what? Enterprise wide means total related to enterprise, complete company wise. EWRA or M you can call it, assesses the risk of anti-money laundering, counter-terrorist financing, means AML and CTF, and sanctions, in addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay, so money laundering, AML, counter-terrorist financing, okay, means terrorist financing. Okay, then second is counter proliferation financing. Okay, this is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this, even bribery and corruption is part of this enterprise-wise risk, because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all. Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory questions, objective questions, and some numericals. So let's start without wasting the time. This is not numerical. Numerical means it's a case study actually. The same case study you get it in the exam. Similar, exactly the same many times. So in on one, sure, it is from your textbook only. Huh? So don't worry, it is not out of your textbook. So there are more chances of these case studies coming in your exam. On 1 June, customer requests to book a forward contract for retirement of import bill for USD 1 lakh, due for payment on 15th September. Given the spot USD INR rate says 75.2729, forward premium as given as spot for June is 10 to 12, spot for July is 21 to 23, spot for August is 30 to 34, spot for September is 43.45, and August to 15 September it is 6.7. So charge a margin of 0.2% on the spot rate. So how to solve this numerical? Such a big numerical. This numerical will be for 5 marks. They'll ask you various questions in this. Very numerous questions. There can be many questions which can be asked from this. But once you are clear in the concept, you can definitely solve all the questions. So firstly, what is it? Forward contract. Okay, forward contract means, immediately remember, it must strike your mind that whenever we say forward contract, I'll mark this line over here because my video is over here, right? So whenever I say forward contract, it means forward contract. It means I'll have to use the forward rates, bill rates. Remember this, bill rates. Okay, this is something you must always remember. Whenever I'm talking of forward contracts, I'll have to use bill rates. Okay, whenever I'm talking of spot transactions, I'll have to use TT rates. Here I'll give you the classification over here. Spot transaction, you'll have to use the TT rates. Okay. Now, if I'm talking of import transaction, import, okay, import, then I'll have to use which rate? I'll have to use sell rate, sell. If I'm talking of export transaction, export, I'll have to use buy, okay, buy rate. Always remember, only in case of crystallization, it's reverse because crystallization is actually the reverse case. But don't worry about crystallization in this case study now. So import we are talking of sell, export we are talking of buy, forward we are talking of bill rates, spot we are talking of TT. Okay. Now I'll ask the questions also to you. Not only I'll answer, but I'll ask the questions also. Now based on this, tell me this contract, what is given about this contract over here? On 1 June, the customer books a forward contract for retirement of import bill. Retirement of import bill means what? The customer has to pay that import bill, pay to that customer. And that payment is to be done when? On 15th September. So this customer has come to you when? This customer has come to you on, okay, let me draw it on the other page, let me see. But before going ahead, everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, remember, you will be getting the latest updates from IIBF on JIB and CIB. Updates means they give various notifications. This subject change, that subject change, this portion change, this timing change, this venue change, all these. So these are immediately updated on this channel. Number one. Number two, what you will be getting is very importantly. So yeah, you will be getting the free YouTube series on all the subjects, free YT series, okay, of CIB as well as JIB. So join it immediately, and whatever is free, grab it fast. Click on the bell icon, click on the like button, okay, share it with your friends, okay. Chalo, let's start this numerical. See, it is, what is the numerical actually? See this, I'll draw it over here. Firstly, let me draw a line over here. Otherwise, what happens? It goes behind my video, okay, here, okay, now. Yeah. So this is what June 1, June 1, June 1. Now the customer has come to you for booking the contract for what? September 15th, isn't it? Look at the date. September 15th due date. So September 15th means you'll have to book this September 15th over here. Let's mark it September 15th over here. So this customer will have to pay to his buyer, his seller on September 15th. He is booking the contract today. Okay. So I'll have to book for this gap. This is known as a forward transaction. Okay. Now September 15th will come in between what? September 1 and September 30th. So September 1 and September 30th. So everyone amongst you will think now we'll be doing this buy low sell high rate over here, but we won't be doing it over here. No buy low sell high over here. Remember, those who are thinking, those who have learned something, buy low sell high maximum, they are using it, don't use it. Okay. Why don't use it? Because the reason is the rates are already given over here. Look at this. If you look at the forward rates, it is given, this last rate is August to 15th September. So exact rate is available for 15th September. So when exact rate is available, you need not do buy low sell high. Buy low sell high is done when the rates are available of September 1 and September 30th. But you don't know the exact rate of September 15th. Then we'll do buy low sell high. But here we have the exact rate of September 15th. It's already given. So now get the forward rates of this forward rate we want, exact forward rate we want it now. This one. How to get this? Start from June. Okay, whatever we have, start from the basic. What is the June rate we are having? June spot is given as 75.2729. Now I'll ask you the question. Okay, is it 75.27 or 75.29? What will I take? 75.27 or 29? What will I take, everyone? Should I take 27 or 29? It is import transaction. Fast. Let me see in the comment section. We don't have time. It is 75.29. Import. Import means sell. So sell means right side. 75.29. Okay, this is the rate I'll be taking. Okay, now I want September 1. What is the September 1 forward rate? Are you having it? See, the spot is given for June. Now, whenever I say June, it means June end. Remember this. Whenever I say July, it's end. August, August end. Okay, September, September end. Okay, so this my transaction is on September 15th. So I can't use this September end rate. I'll have to use the August end rates here. September, August end equals to here. August end, it's equal to September 1. September start. Okay, this is like the closing cash and opening cash of your bank. What is the closing cash for yesterday is the same as the opening cash for today, isn't it? Volt cash. So same logic is used over here. So August end equals to September start. So I want it for September 1 now. So that will be August end rate. So I'll be taking 32, 34. Which one will I take? 32 or 34? Should I take 32 or 34? I'll take 34, right? So now tell me this is 34. Okay. Now tell me whether the currency is in premium or discount over here. Everyone type in the comment section 10, 12, 21, 23, 32, 34. So is the currency in premium or is it in discount? What do you say? It's in premium. Remember, when your right side is higher, right side is big. Okay, in forward transactions, the currency is in premium. Always remember this, premium. When your right side is big. So vice versa is also true. When the right side is small, it is in discount. And whenever we have premium, we'll have to add the forward points. Always add. Okay. So now it is in premium. I'll have to add it. But see this 34, I'll do it. I'll take this 34 now. Oh, over here. I'll take this 34. So what is my rate now? 75.29 plus 0.34. Take this point. Huh? So what is the answer now? 75.29 plus 0.34. So what is the answer you're getting? It is 75 point what? 75.6 and 3. 75.63, right? Add this. How many of you have got this? 29 plus 34. 33, 43, 53, 63. Isn't it? This is one. But I want it for September 15th now. So what will I do? I'm having this rate up to September 1. I'll take the forward points for September 15th now. What are the forward points given? 6 and 7. Okay, this one, 6 and 7. Seeing this? 6 and 7. So what will you take now? 6 or 7? Everyone type in the comment section. You will take 6 or 7. I'll take 7 because sale. But I won't take only 7. It is 0.7. 0.07 because we require after 0.2 digits. So 0.07. So what is this now? Again, premium or discount? Premium. So I'll add this. So it will be 75.63 plus 0.07. So 75.70. This will be my rate for September 15. Exact rate for selling. Okay. Selling. But is this a final answer? No, this is not the final answer. Why? Because I have to charge this margin also, TT margin. Where is it mentioned? We have not mentioned anything about the TT margin. So what is the TT margin then? Say this TT margin is always taken like this. Whatever rate you get, 75.70 into what is that? 0.2%? What is it given? 0.2%, right? So 0.2 upon 100. 0.2 upon 100. So what is the answer you're getting? Try it on the calci, everyone. Everyone should be able to do this now. Fast. Everyone should be able to do this. Fast. Try it on the calci. What is the answer you're getting? Everyone. Yeah. Let me also try along with you. So 75.7 into 0.20. So 0.02 you can write it, or you can divide it by 100 later. So it is, what is the answer you're getting? You're getting 0.1514, right? This is the answer you might be getting, right? 002. So 0.002 into this. So 0.1514 you are getting. Are you getting this? Everyone type yes in the comment section if you are getting it. Are you getting the same answer? Okay. Chalo, move on. So this is my margin. So what to do with this margin? Remember, whenever you are selling, you'll always add the margin. TT margin. Huh? And whenever you are buying, you'll always subtract the margin. Okay. So now what am I doing? What am I doing? I am doing the import transaction, means selling. So I'll add this. So what will be my final rate now? 75.70 in plus 0.1514. So what is the answer you are getting? Add it. So let me see the answer from your side. It is 75.7 plus 0.1514. Everyone tried 75.85. 75.8514. This is the exact answer you will be getting. And this is your final answer. Okay. But what do you mean by this rate? What has happened actually? In this whole transaction, you have got the rate. But what has happened? This much amount you'll be debiting it to the customer. See this 75.85 because $1 lakh are to be given. So what amount will you be debiting to that customer? So 75.85 14 into 1 lakh. $1 lakh, right? 1 lakh. So whatever that amount is. So it is around 75 lakhs, right? That much will be the amount, isn't it? Yeah, into $1 lakh. So multiply this. So you'll get something 75.8514 lakhs. This much amount you will be debiting to the customer and then passing on the $1 lakh to the next party in foreign. Okay. So this was the actual case study. In exam, how will they ask you? They'll ask you various questions. They'll ask you, okay, what is the spot rate for June to be taken? Okay, what is the September 1 for this forward rate? What is the September 15th forward rate? Will you be using buy low, sell high in this exam, in this question? So these all questions will be asked to you and you must be prepared for that. For that, you must have studied this case study. Okay. Before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, everything you'll be getting. Okay. Whatever we need for clearing JIB and CIB, we get it over here. So that's why everyone download this app immediately and start studying. Okay. Second numerical. Now this is not a simple one, a confusing one, but let's see how many of you can answer this. A forward purchase contract USD 5 lakhs booked 2 months back at 75.25 is due for delivery 2 days later. The customer is informed by the drawee of the bill that the payment will be delayed by 1 month. Now this much is your case study. See here, there is a contract which was booked. Okay. 2 months back means I'll write it over here. Say this. 2 months back, there was a contract which was booked for due for tomorrow. Means here, let's say tomorrow. Okay, here it is tomorrow. So 2 months back, what is this month now? Let's consider anything. This is September. Okay. So gone August and July. So July, let's say the contract was booked. It is due in September. This tomorrow's date, let's say. But what has happened is customer is told now by his buyer. See here, forward purchase contract. This is a purchase. Purchase means it's an export transaction. Always remember. Purchase is always export. So this buyer has told, buyer means what? The buyer of your customer. That buyer was going to pay the customer on September. But this buyer has said that no, I won't be able to pay you now. I'll be able to pay you after 1 month. So I'll be able to pay you in October. Now what have you to do? In this case, what have you to do? This contract was already here. This is contract number 1. So this contract number 1 was booked over here. Okay. So if it is booked, it has to be nullified over here, cancelled over here, cancelled. Here, the rule is very simple. Whatever is booked has to be cancelled, or either it has to be paid or it has to be cancelled. So if it has to be cancelled, it's like the same rule. जिसको आना है वो जाएगा. Right? Simple rule. The one which rises will always fall. The one which is booked will always be cancelled or paid. It will be equated. Okay. So this is to be cancelled. But remember, if it is to be cancelled, it doesn't mean because the payment is to be received in October. Is the payment received up till now? No. Payment is not received. So what will I have to do as a banker? This now the role of the banker comes in. The banker will have to cancel transaction number one and will have to book a new contract. Book new contract for October, this 1 month, because up to the time payment is not received, the transaction is not over. Okay. So the bank will have to do two transactions over here. One is canceling the older one and booking the new one. Okay. Now let's look at it. So rate of booking of the original contract is means when it was booked in July. At what rate was it booked? TT buying rate. Okay, let's consider this ABCD. A, B, C, and D. So now, when the contract was booked in July, at what rate was the contract booked? TT buying, TT selling, bill buying, or bill selling? What do you think? Purchase contract. Purchase. Purchase means what? It will be buying. Okay. Purchase means buying. Buy. So if it is buy, then what? Now the answer is only two. Two are remaining. Either TT buying or bill buying. So which one? Just now I told you in the first numerical. Whenever you are booking a forward contract, you will always use which rate? Bill rate or TT rate? Just now. Just go to the part of that video again. You will be taking bill rate. So the answer will be bill buying. So the original contract was booked at bill buying rate. Remember this. This bill buying rate is 75.25. Okay. Second question. Rate of cancelling the original contract is what? TT buying, TT selling, bill buying, bill selling. So cancelling, this cancellation means this. Cancelling transaction number one, this one. This is to be cancelled when? It is due when? Tomorrow. Tomorrow means spot. Always remember. This is spot. So here I'll have to first use spot. Spot means what? Whenever we are doing a spot transaction, which is to be rate is to be used. Again, first problem. Just now I gave you. Spot you have to use in the comment section. Let me see. Spot you have to use TT rate or bill rate. Okay, I'll give you options. TT or bill. So which rate will you use? TT or bill? TT rate, correct? So TT is okay. So now these two are out. TT is only in. TT buying or TT selling. Now I'm cancelling the contract. So if the contract was booked at what rate? It was booked at the buying rate, right? So originally it was booked at buying rate. So cancellation will be done at what rate then? Will it be buying or selling? So if I do something at buying, I'll have to cancel that using selling, right? So I'll be using bill, this TT selling rate, right? So the answer will be TT selling rate over here. Okay, cancelling is always done at the reverse rate of the booking. Okay, then you'll say why not bill booking, bill selling then? But because bill selling is not used. Bill is used whenever you are doing some future dated transactions. Here I am cancelling tomorrow itself. So it is a spot transaction. So TT, isn't it? A rate of booking the new contract for next 1 month. So next contract will be booked at what rate? TT buying, TT selling, bill buying, bill selling. Who can give the answer? New contract for 1 month now. Simple logic. You have the answer only here itself only. You have the answer here. Let me see the simple logic you can give. See here, contract number 2 which is booked is same as contract number 1. Because there also I had booked it for purchase. Again I'll have to book it for purchase because same thing is repeated. This full whatever had happened in July is repeated on over here now. Same thing is repeated. So if it is repeated, then the rates will also be repeated. So it will be again bill buying rate. So I'll be using bill buying rate. But the rates will be different. Of course, not the same rate. But the logic is same. I'll be using the bill buying rate only again. Again, new contract. Of course, the rates will be for today, whatever the rates. Hi friends, welcome to the Scholar series of BFM. Here we are covering important theory, questions, objective questions and some numericals. So let's start without wasting the time. So, fintech. First definition, fintech means what? Fintech refers to the synergy between the finance and the technology. See here, sometimes they call it fintech and there is a separate word called as techfin also. Techfin. Okay. So techfin and fintech, these are not same words. Fintech means first finance and then technology. Finance plus technology. So basically this company is in finance and then it is using technology. But techfin over here means the company is in technology. Understand the difference? Technology and then it is doing finance. Okay. Now you'll say, sir, what is the difference? Only words are the different over here. See, the difference is like this. Suppose SBI. SBI will fall in fintech. SBI, HDFC Bank, all are banks. They are fintech. They are first finance, then technology. Techfin means what? Google. Google will fall in techfin because it is first technology and then it is giving loans. Phone Pay. First it is technology, then it is giving loans. Google, Phone Pay. Okay. So these are all the techfin companies. Understand the difference. There is a slight difference in the words, but huge difference in the overall companies. Okay. So finance plus technology. Fintech refers to synergy between finance and technology. Okay. Second one, regtech. Now, what is this regtech? See, the words you can break it up over here. Reg means regulatory. Reg plus tech. So, reg refers to regulatory. Technology in regulatory aspects, focusing on automation of the compliance processes for the banks, right? So, automation of the compliance. What do you mean by automation of the compliance? What is this? Okay. Here, I'll give you simple reason, simple logic behind this. Compliance. Let's talk of simple terms like large cash transaction report. Okay. Large cash transaction report means any transaction about 10 lakhs of cash, right? So in large cash transaction report, why has a bank or the employee to report it? As you are having the technology over here, right? So immediately it should be reported, it should catch which is the large cash transaction report and give it, isn't it? So that is known as automation. Similarly, for this bill of entry also in trade finance. Now, those who have covered this batch, those who are in the batch, they'll understand the SDF form and BF form. BEF. I told you BEF entry is now BEF report is now removed, right? Why? Because of this automation in the technology. Means bill of entry, whatever is coming in, why should it be reported separately now? Once it's in the customs office, you get it through their system, it is automatically reported to RBI, isn't it? So automation means reducing or removing the manual work in the compliance part at least. Okay. Because compliance, always the problem in compliance is if there is a human intervention, always it faces the problem. There is some error, some manual error. So if it is done by machinery, nothing as such. What has happened in clearing now? Isn't it? What is clearing? Clearing is gone now. It's all automation now, isn't it? AI, artificial intelligence. It refers to the simulation of human intelligence in machines that are programmed to think like human beings and mimic their actions. Understand this? Programmed to think like human beings. You'll say, sir, how can a machine replace a human being? Of course, it can't. No machine can replace a human being. But if you look at your banking activities, what are you doing in the banking? Tell me. If you look at the banking activities, just tell me one answer. Everyone give me the answer in the comment section. Give me one answer. How much part of your job is repetitive in nature? Repetitive means daily you are doing the same job. Same job, same desk, everything. So how much part of your job is repetitive? I'll give you two options. One is almost 90% of your job, and second is 10% of your job is repetitive. Every time it's a new job. Right? Give it in the comment section. Everyone write in the comment section. How much part of your job is repetitive? Correct. Almost 90% of your job is repetitive. 90%. Because daily you can't have new things, isn't it? Will you have daily new challenges? No. We'll have repetitive job almost every day. Some days some new thing comes. Okay, so whatever is repetitive, that can be done by the AI. Here, simple thing is, whatever is repetitive can be handled by the machines. It's that simple. Okay. and mimic their actions. Mimic means rehearse, means do it again. Okay. So AI basically, whatever you are seeing right now, chatbots. What are chatbots? Chatbots we see everywhere nowadays. You go to any site and you see, may I help you? Then you type in that message and then you get chatbots. So now chatbots have gone to the higher level. Now we have something called as chat GPT. So chat GPT, what do you get over there in chat GPT? You get various other things also. Not only this replies, but also you get the this artificial intelligence helps you to find the answers to the repetitive questions of the customers. Okay. Next is machine learning. Machine learning refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history, behavioral pattern, advisory services, etc., thereby enhancing the customer experiences with the banks. Now, what do you mean by machine learning? Here, machine learning is known as learning by the machine. It refers to the algorithm by analyzing millions of data sets to provide inputs to the banks. So, learning by the machine means this is called as there's a word in machine learning that is called as cognitive. This word you will hear many times. Okay, cognitive, TIVE. Okay, cognitive means continuous learning. It refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history. So, whatever are the customer transactions, whatever are the behavioral patterns of that customer, advisory services. So, all these things basically behavior patterns. Here, if you see the behavior pattern of any customer in the at least in the financial field, by that you can definitely govern which products are to be sold correctly to that customer. Okay, thereby enhancing the customer's experience with the banks. So if the customer receives proper treatment or proper advice as per the customer's requirement, then definitely what happens in that case, the customer will stick more to your bank rather than giving some vague. Means, for example, I'll give you, suppose if any customer is requiring, let's say, loan. Okay, he is facing some financial problem and you are trying to pitch to that customer insurance or mutual fund. These are investment products. So will that customer come for this mutual fund or investment with you? No. That customer requires a loan, so you have to pitch in the loans. How will you know whether that customer requires a loan or not? Through his or her behavior pattern. Okay, behavior pattern means if that customer has asked for the loans, or if there is huge cash withdrawal or transfers from that account. So that is all captured under AI now and machine learning. Okay. So it refers to the usage of algorithm. Remember this word algorithm. What is algorithm? Algorithm is a set of computer programs. Okay, done. Computer programs. Okay, which make this machine think on the repetitive jobs. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates on JIB and CIB. Number one. Number two, you will be getting all the free YouTube series on JIB and CIB over here. So subscribe to it, click on the bell icon, click on the like button, click on the share button, share it with your friends, isn't it? What is big data and data analytics? See here. Big data deals with the data sets that are too large or complex to be dealt with the traditional data processing application software. Now, what do you mean by this? See here. Many times in your computer itself, we see our own computer, your home PC it might be, or in your bank PC also. The computer operator or the admin guy, systems administration, when that person checks your computer and he or she says, your data is too much loaded, your server or your CPU does not support it, your laptop doesn't support it, memory is too much gone. What is that? What is that person saying actually? That person is talking of big data. See here, every machine has its own capacity. Okay. Suppose if I want a huge data analysis of entire banking industry, I can't keep it on a single PC or even a simple server. For that, huge servers are required, right? So big data deals with data sets that are too large or complex to be dealt with by traditional data processing application software. Okay. Big data is advantageous where volume, variety, and velocity of the data is huge. Now understand the three words, very important. Okay. Volume, variety, and velocity. Velocity means speed. We require huge speed. Okay. Science graduates might understand this. Okay. Velocity is speed. So volume, variety, and speed. All the three things are required and they are huge. Volume is huge means if you consider SBI, what will be the volume? If you consider your own bank, forget SBI, your own bank, what will be the volume? Per day volume. It will be huge. So your server needs to cope up with such big volume. Variety. There are thousands of transactions, variety of transactions. So all the variety needs to be captured in your system. Similarly, velocity speed. If you imagine in the bank, if when you are using your system, and if it takes around 1 minute to answer, even 1 minute is a long time in front of that customer. Waiting for 1 minute is a huge time. Okay, so that's why it needs to be at a huge speed. That's why we have all these 4G, 5G, 6G, all these things. Okay, got it? Data privacy and digital privacy. Now what is this data privacy? See this, these words you many of you might be knowing now by now, isn't it? Privacy means secrecy, right? Digital privacy, same. Okay, digital and data both mean one and the same thing. So data privacy or digital privacy refers to the protection of an individual's information that is used or created while using the internet on a computer or a personal device. So what do you mean by this? Refers to the protection of individuals' information. Individuals' information. Okay. Now what all information can the individual have? Individual will be having various informations like name, mobile number, that is common thing, address, right? But like graduate, what is your education level? Then what is your family size? Are you holding any assets, car or anything? Okay. Plus, have you taken any loans? So these are all the individual informations. Remember, individual information can be of two types. Always remember, it will be of two types. One is static, and second is dynamic. Okay, dynamic. Static means what? Which does not change. Means what? Your name, generally your name, your address, or your Aadhaar number. These don't change. PAN number, they don't change at all. What is dynamic? Are you holding a car? Are you holding some loans? These are all dynamic things, right? Education level is static generally because once you are educated, you won't change your education. Yeah, generally I'm talking, huh? Somebody can do the changes in that also, okay? So static and dynamic means that, okay? Refers to the protection of individuals' information that is used or created while using the internet. While using the internet means whenever I fill up any form for Google, or if I fill up any form for your bank, online form. So if that form, it gives my all the details and that is breached, that is shared by your bank, let's say, with someone else. So what is that? That is affecting my privacy, isn't it? While using the internet on a computer or a personal device. Personal device means anything related to computer or mobile also. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing the JIB and CIB, we'll be getting it over here. So that's why download it right now. Okay. Data breach. What is data breach? Sure. Just now we talked about data privacy. Importantly, remember these are all the important questions, and you'll get some of them, at least two or three of them, two at least out of this series, whatever we are talking right now. Today's session, you'll get at least two 1 mark questions in your exam. Okay. So now you know, everyone among in CIB knows the difference between 1 mark, the importance of 1 mark. The difference is 49 and 50, right? 49, 50 is cleared and 49 is not cleared, isn't it? So data breach. Data breach refers to the security incident in which malicious insider or external attackers gain unauthorized access to the confidential data or the sensitive information such as medical records, financial information, or personally identifiable information. Now, data breach means what? Just now we discussed about the static and dynamic, right? Dynamic means what here? This secure generally this dynamic information is very sensitive, because static information generally everyone knows. Where are you staying? What are you doing? Okay, all these things which don't change. They generally everyone knows. What is important is dynamic, and all the companies want this dynamic data, because it is changing. It is changing, and what happens? Your habits are changing accordingly. So, data breach refers to security incident in which the malicious insider. What do you mean by malicious insider? Insider means that person working in the bank itself. That the person compromises the data and gives it to some other external company or external attackers. External attackers means what? These are all those attackers, these cyber attacks. Okay. So these cyber attackers or these insiders gain unauthorized access. Unauthorized means even the banker will can get unauthorized access. Suppose if you are in the branch, do you have the access to the head office data or sensitive data, balance sheet and everything? Do you have access to that? No. That is, if you have access, you are in the branch, you have to get access only to your part. So that is known as unauthorized data. If you get information about something else which is not required by you, so that is known as unauthorized data. Okay. So unauthorized access to the confidential data or the sensitive information such as medical reports, financial information, or personally identifiable information. So medical reports, sure, that's what I said. These all things are dynamic. If you check this, these are all dynamic, right? Dynamic means what? They go on changing. Dynamic, right? Medical reports, they go on changing. Financial information changes. Personally identifiable information, right? So these are all the changing things. Okay. So mainly the access to this is required by the companies so that they can sell the various products to you. Okay. P2P lending means a financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. P2B. P2B means peer to peer. This is known as peer to peer, or in simple you can call it peer to. It's two, peer. In simple way, peer. You can call it peer, people to people. P2P lending is an important aspect coming. This P2P lending will change the entire banking scenario. Remember this. So, financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. So, P2P lending will change the entire. See, right now, what is happening? Why are people depositing money in the banks? Because they don't know who is to pay, who wants the loan, and they don't have the confidence on that person who will get the loan, right? Suppose if I get somebody, tomorrow you require the loan. Okay, you require, let's say, 1 lakh rupees, and I am having excess 1 lakh rupees. So why should I deposit it in the bank and then that bank gives you the loan? I'll directly give you. So that is known as P2P lending. So there are certain problems in that, but those can be tackled nowadays. There is account aggregator system that can definitely tackle it. So it means secured and unsecured personal loan, the person who wants it with the investor, connecting this buyer and seller. It's that simple. Cloud computing, it refers to the delivery of computing services including servers, storage, databases, networking, software, analytics, and intelligence over the internet to offer faster innovation, flexible resources, and economies of scale. Cloud computing, you must definitely know this definition because this is the important part of technology in international banking. Computing services including servers, blah blah blah, storages, databases, software, analytics over the internet. Now remember, over the internet means this is the server will not be a physical server, it will be in the cloud. You might have seen many of these, right? Many of the companies have come like that. What GoDaddy, right? There's a company called as GoDaddy. Check that, okay? That is giving online servers. Okay, there is many of them are there. One I know because I've used that data. Servers, storage, databases, networking, software, analytics, everything on the internet. There is no physical existence. To offer faster innovation, flexible resources, and economies of scale. Right? Clear? So everything is on internet over here. There is no physical thing. Okay? Now, to join, as I told you, join this Adda 24/7, download this app or join the YouTube channel. But how to join it? See, just scan this QR code right now. This blue QR code is for Telegram channel, official Telegram channel. Scan it. For all, you might be in JIB, you might be in CIB or any other bank promotion. Similarly, YouTube. Scan this right side QR code, this one, okay? This QR code. Then if you want to join this Instagram, okay, join this QR Instagram. Okay, scan this QR code and you'll join this Instagram channel. Remember, there are many fake channels available. Fake channels. So we need not join those. Okay? Because here in the world there are always copycats, right? So that's why join it immediately. DigiBank, an entire bank squeezed to fit in your smartphone. DigiBank, there is no physical existence of that bank. Remember, there is no physical existence of that bank. There is only one head office. There are no branches. DBS has started DBS. They have started DigiBank. Many of the Indian banks have also started DigiBank. No physical branch. Only head office. That's it. Regulatory sandbox. This is a new definition. It refers to an environment where it allows the regulator, the innovators, and the financial service providers and the customers as final users to conduct field tests to collect evidence on the benefits and risk of the new financial products. So, where regulator, innovator, and the financial service providers. Now, look at this. All these elements, these are all the we call the stakeholders. Regulator, innovator, financial service provider, customers as a final user to conduct field test to collect evidence. So field test is collected. Important part over here is field test. Okay, conduct field test to collect evidence on the benefits and risks of the new financial product. So whenever I am launching a new product, what are the benefits of that? Will it be harmful? Will it suffice my this purpose? So that all evidence is collected using this regulatory sandbox. Okay, understand this word is very important. Conduct field test to collect evidence on the benefits and risk of the new financial products. Robotic process automation. It refers to the process of assigning manual repetitive tasks to robotics instead of humans in order to streamline workflows in financial institutions. So it refers to what? The process of assigning manual repetitive tasks to the robotics here. Assigning manual repetitive tasks to the robotics instead of human beings. So robotics instead of human being. That is the basic logic behind this robotics process automation. So human beings should not be used for repetitive jobs. Human beings should be used for innovative jobs. Okay. Blockchain technology. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Okay. Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM, and here we are covering all the important theory, numericals, and objective questions. Okay, watch the series till then. Very important numericals are covered over here, and very important objective questions are covered over here. So watch the series till the end. Let's start. First one. Read this. To calculate the VAR, value at risk, there are following approaches. Firstly, before going to the question, what is VAR? What is VAR? Value at risk means VAR. Look at this, VAR. What do you mean by this in simple terms? Okay, I'll give you a simple example. Suppose if I have invested in, let's say, Reliance share, Reliance. Imagine, let's say the price of Reliance is right now at, let's say, 3000. Okay. Now what is my VAR? Is my VAR complete? Value at risk means what is my amount at risk? Is my amount at risk complete 3000? No. Suppose if this is the price of Reliance 3000, okay, and this Reliance share is fluctuating per day, per week, depending on my this tenure or my period. Suppose in a week, or let's say in a month. In a month, let's say Reliance is fluctuating 5%. Okay, so 5% here and 5% there. So it will be what 5%? It will be 1500 over here and 1500 over there. We are 5%, 5% into 3000. Okay, so it will be 1500 over here. It is 1500. So this is 1500. Okay, and this is 1500. This. Okay, 1500. So if it is fluctuating 1500 on both the sides in one month, let's say, then my VAR becomes what? My VAR becomes the total of this. The total is 3000. Okay, sorry, 3,300. Sorry, yeah, it becomes 300, right? Because the price was 3000. I took it for 30,000. Okay, so this will be 3,300. Okay, so 150 over here, 150 over here. So it will become 300. So my VAR becomes 300. So got it? What is VAR? The fluctuation which is happening in that stock is known as VAR. Now this example I gave you for Reliance, a stock. It can be a commodity, it can be a dollar, it can be a gold, anything. Okay. So to calculate the VAR, there are the following approaches. Correlation method, also called as variance or covariance matrix method. Historical simulation method, Monte Carlo simulation method, and Macaulay's duration. So the options are 1 to 4 all, B is 1 to 3 only, C is 2 and 3 only, and D is 1 and 4 or only 1 and 4. This is not 1 to 4. Okay. So what is the right option over here? Search in the Google. Have you read it? Anyone has read this? How to calculate the VAR? It's there in your module B. Okay, module B of your this BFM. So how to calculate? What is the method used? Everyone, let me see. What is the method used? It is 1 to 3 only. See here, it's not, Macaulay's duration is not used to calculate the value at risk. Macaulay's duration is used, Macaulay's duration is used to calculate that. What is Macaulay's duration? Macaulay's duration is that period of the bond in which the interest rate risk is zeroized. Interest rate risk equals to 0. Okay, that is the Macaulay's duration. Okay, to calculate the value at risk, the various approaches are based on the following basic parameters. So to calculate the VAR, what are the approaches that are based on the following parameters? So means all these approaches, or the 3 approaches which we saw over here. Okay, so they are based on what parameters? Holding period, historical time horizon, holding period, confidence interval, comma. Okay, historical time horizon and confidence interval, holding period, historical time horizon and confidence interval, all the 3. So what is the option? Correct option A, B, C or D? What do you say, guys? Think over it. Think of the answer. Think of the answer, everyone. Yeah. Is it 2? B or C? Is it B or C? See here, the correct answer over here is, okay, before that, before giving the correct answer, let me explain you. Value at risk. Okay. What are the parameters? So what do you mean by this word holding period? Holding period means for what time am I going to hold that bond? Means am I going to hold that bond for 2 years, 3 years, 1 year? Okay, so holding period is time. Time equals to holding period. Okay, so equals to holding, right? Second is what? Historical time horizon. Okay, let's look at this. What is historical time horizon? Historical time horizon means what is the duration for back testing I am considering. See, this back testing is an important parameter in your BFM. That's why I said join the batches as a back testing. Okay, because here everything is not able, I won't be able to explain everything. Back testing. Okay, so historical time horizon relates to that. Okay, historical, I'll just write the short form over here. Historical. Oh, only historical. TH I'll write, time horizon. Okay. Then confidence interval. What is confidence interval? See this. This confidence interval consists of 3 parts. Okay. In fact, there are 3 parts. One is confidence level. Then there is a mean, and then there is a variance. Okay. The 3 parts over there. So depending on that, the value of your bond changes. The confidence intervals are, you might have heard of these 3 confidence levels, intervals or levels also you can call it. 68%, 95% and 99.7%. Okay. So these 3 are the important parameters while calculating the value at risk. So what is the correct answer then? So the correct answer over here is D. Okay. The dash method for calculation of value at risk is deterministic approach. Dash method, see this, is a deterministic approach. Correlation method, historical simulation, Monte Carlo simulation, and all of the above. Think over it. Deterministic, firstly, what is deterministic? Deterministic means what? Deterministic means what? Deterministic means there is a relationship between the 2 parameters. That's the meaning of the word deterministic. Relationship between the 2 parameters. Okay. And the relationship between 2 parameters is done in which method? You might have studied this in your APM. In which methods we use this between 2 parameters? Do we use it in historical simulation? Do we use it in Monte Carlo, or do we use it in correlation? Answer fast in the comment section, everyone. Comment section. Dash method for calculation of value at risk is deterministic approach. Let me think. You should think, not me, isn't it? Yeah. What is the correct answer? Okay, the answer over here is, I'll explain you all. The answer over here is correlation method. Always remember that deterministic means comparison between 2 parameters. You should be able to get the exact answer. 2 parameters comparison. Comparison. Okay. And exact answer. These are the 2 points about this. Exact. Okay. Historical simulation and Monte Carlo simulation are scenario analysis. These are known as scenario analysis. Monte Carlo is for scenario analysis. This is scenario. And historical simulation is related to SEER. Again, it's a simulation only. So these are simulation methods, and this is also related to back testing. But this correlation method is a deterministic, means here exact answer you will be getting. So correct answer is A over here. The historical simulation approach in the market risk calculates the change in the value of the position using. So this historical simulation approach in the market risk calculates the change in the value of the position. Means, what do you mean by this? See, this historical means, what did I give you? I give you, what did I give you? Give you, not give you. Okay. What did I give you? The historical simulation approach in the market risk calculates a change in the value of the position using the actual historical movements of the underlying assets starting from the current value of the asset. Projected historical movements from the underlying assets starting from the current value of the assets. Actual historical movements of the underlying assets starting from the future value of the assets. Sample of randomly generated price scenarios. Very confusing. Okay? Everyone think over it. Very confusing. Yeah? Think over it. I'll just wait over here. See this. I'll give you a few hints over here. Actual historical movements. Actual historical movements. Second is projected historical movements. I'll give you the hint over here. Actual historical, projected historical. And depending on the current value. So these are on current value. Okay? Current value, current value. Third, C1 is actual historical movements depending on the starting from the future value. Now you think over it. And last one, okay, simple sample of randomly generated price scenarios. Forget this. So the answer is between A and C. Think over it. A and C. What do you think should be the answer? Think over it logically also. Suppose if you don't know the answer, in exam it happens many times that you don't know the answer. So in that case, what will you do? First, you go on. You should go on this elimination method. Elimination means randomly generated. First, eliminate that. Nothing is randomly generated in statistics. Then projected historical movements. Projected. How can the historical movements be projected? Historical movements are actual movements where we have seen the actual thing. You can't project history, right? So B is also gone. Now A and C, actual historical movements based on the current value and actual historical movement based on the future value. How can I start from the future value? I don't know the future. So the correct answer over here becomes A. Okay? It will become A. A is the answer. Okay? Next one. The Monte Carlo simulation method calculates the change in the value of the portfolio using the Monte Carlo simulation. This Monte Carlo simulation, what is this Monte Carlo? Firstly, understand this. Okay, I'll give you in one line. Actually, it is a deep session which I do take in the paid classes, but in one line I'll give you. Monte Carlo simulation means what? Here, it's a refinement scenario. Refinement. Refinement means what? Refinement. This is known as refinement scenario. What is refinement scenario? It means that suppose if I do the session today, means if I do a meeting today or think of any scenario today, okay, then my team will sit over here. My team of let's say 5 members sits over here, decides on various points. After it decides on various points, means that meeting comes up with 5 points. After these 5 points, we refine those 5 points, and next time when we discuss, again we'll be sitting. So there will be around 3-4 meetings or 3-4 refinements, we call it refinement. First refinement, then second refinement. Again these 5 members will sit, and when we sit for the next time, okay, we will discuss only those 5 points which we had come up in the earlier meeting. Okay, so only those 5 points. From here, what happens? We come up with, let's say, finalize on 2 points. So now we finalize on 2 points. Okay, I'll just write the points now. 2 points. Okay, one sec. So here there are, let's say, 10 points, 50 points, okay, 50 points. From here we refine to 5 points. Second meeting. From second meeting we refine to 2 points, okay, means we are going on refining the scenarios, what all can happen. So that is Monte Carlo simulation, and in the end from the 2 points we come up to the single point, which is our main answer. So that is Monte Carlo. It goes on refinement. Means this I have given you in the layman's language. Okay. The Monte Carlo simulation method calculates the change in the value of the portfolio using actual historical movements of the underlying assets starting from the current value. Now see here the answers are similar to that earlier one. Projected historical movements of the underlying assets using the current value of the assets. Actual historical movement of the underlying assets starting from the future value of the assets and sample of randomly generated price scenarios. Answers seem to be similar. Answers seem to be similar, but the answers are different over here. Again go on refinement. Here we are talking of Monte Carlo simulation. Means here various points are considered. All the points, all the required points, all the required scenarios are considered. All the things which can happen in the world are considered over here. So what all things can happen? Can happen. See here, Monte Carlo simulation is can happen. Look at this. This is futuristic. Okay, futuristic. So can happen. Can happen. Now when I say can happen, then what happens? This history goes off. History is of no use to me. Okay. Now the answer can be only this: actual historical movements of the underlying assets starting from the future value of the assets and sample of randomly generated price scenarios. Now the real fight is between C and D. Think over it. What can be the answer for C and D? What can be the answer? Either C or D. Think over it. Yes? What do you think? The correct answer is? Think things here. Again apply the elimination method. Monte Carlo simulation means it can happen. Whatever things can happen in future. That is Monte Carlo. Okay. So whenever you think of future, firstly eliminate the history part. Now you can see the history part. You can look at this C, but there's the word of future. That's why I've kept it. Otherwise C is also elimination. So the answer over here is C is also gone. So the answer will be D. Sample of randomly generated price scenarios. Remember, randomly generated, because what all Monte Carlo simulation is used for checking the future scenarios. These 50 points, 50 scenarios will be randomly generated. Out of these, various thinkings will be done, discussions will be done, and then we'll come up with, here I've given the example of 5. We can come up with 25 first. From 25 we can come to 5. From 5 we can come to 2. That's the way it goes. Okay. So the answer is D over here. In which of the following methods to calculate a change in the value of the portfolio, the user has not to make any explicit assumptions? Not to make, remember, not to make any assumptions. No assumption is required. No assumption is required means what? It means that directly whatever are the facts, use the same. Whatever are the facts, use the same. Think over it now. Answer is very easy in this, and it means I gave you the hint also. Whatever are the facts, use them. So where are the facts? In which method are the facts? Correlation, historical simulation, Monte Carlo simulation. A and C both. Correlation and Monte Carlo. A and C both. Generally we have a tendency in exam. Whenever we see this A and C both or all of the above or something A and B like this. So we tend to answer that A and C or A and B. Comment section. Give me in the comment section, everyone. Give it in the comment section. So it is. Many of you have the tendency of typing A and C. So the answer is not D. Remember, A and C both is not the answer. Either A, B or C. But now we are talking about only facts, no assumptions. So no assumptions is a part in history. In history, do you make any assumption? No, right? So B is historical simulation. This is the answer. In historical simulation, the user does not have to make any explicit assumptions. Okay. Which of the following is the usefulness of VAR? Means value at risk is used where? Why VAR is important? So, number one, good tool for fund managers to for protection of customer businesses. Okay, good tools for fund managers to protect the customer businesses. So that is the first answer. Second one, think over it. What is the second one? Yeah. I'll make it a bit simpler. Okay. Think over it. By the time you read, what is the answer? Now give me the answer. A good tool for fund managers for protection of customer business translates portfolio exposures into potential profit and loss impact. A vital component of the current best practices in the risk management. Meets the external risk management disclosure and expectations. 1 to 4 all, 2, 3 and 4. 1 and 4 only, and 2 and 3 only. Okay, let's discuss these 4 options. Good tools for fund managers for protection of customer business. Is it a good tool? Value at risk. I gave you that example of value at risk. Reliance 3000, 5% fluctuation, 150 here or there, right? So total 300. So if I know the fluctuation of any stock or any commodity, will I be able to protect my or not protect, actually no, protection is not, will I be able to minimize my risk if I know the fluctuation? Yes, I can. So that's why my business funds will be protected. So A is the answer, 1 is the answer, right? So that's why this is the right answer, 1. What about the second? Translates portfolio exposure into potential profit or loss impact. How much can be the profit, how much can be the loss by the fluctuation of that Reliance share by 5% here and there? Definitely that I can predict, right? Means how do the banks predict that this year our profits will be around this and this? How do the banks predict? Banks predict based on your VAR. Okay. A vital component of the current best practice in the risk management. So current best practice in the risk management. Remember, VAR is the best tool nowadays available for any banking calculation. Any banking. Okay. So C is also the answer. Meets the external risk management disclosure and expectation. So this is the part. This is a important condition in the Basel norms. External risk. Basel norms consider systemic risk. Very important. Systemic risk is an external risk, which is not because of you. It is basically the settlement risk. Okay, means a part. Systemic risk is a part of your settlement risk. So it meets the external risk management disclosure and expectations which are required by the Basel norms now. So the answer is all 1 to 4. Correct? 1 to 4. Remember, this external risk management disclosure is an important part in the Basel 3 now. Basel 3. Remember, Basel 3, I'll write it. Basel 3 is an important term. 1, 2, 3. Okay. Important term, and all the banks are now following Basel 3. Okay, those who don't know, we are all at Basel 3 now. So that's why I'll again tell you, join the paid classes. Okay, here we are covering all the important points. The process where the model based VAR is compared with the actual performance of the portfolio is known as back testing, stress testing, downside potential and duration. Think over it. This I won't answer now. Let me see how many of you answer first. And answer is, I've given you the hints in this session only. The process where the model based VAR is compared with the actual performance. Actual performance. Okay. Where do you base it with compare it with the actual performance? It is done in back testing. Again, back testing, we see here, what is back testing? Back testing means consider the scenarios for last 10 years. Means period can vary. I'll consider it for 10 years. Somebody can consider it for 5 years. Somebody can consider it for last 50 years. Okay? Like COVID. COVID didn't happen in last 100 years, but then it happened. Suppose if I compare, all the banks were comparing their portfolios for last 10 years before COVID. But what happened? One COVID year, last 10 years, I'll give you a simple method, okay? Last 10 years, the fluctuation in the markets was this way, somewhere like this. So last 10 years, there was not a major fluctuation, but COVID came, and what happened? This fluctuation went down like this. So suppose if I consider, if I would have been over here, okay, then I would have thought nothing can come like this. I'll just consider this much VAR. So my historical calculations or back testing was comparing this actual performance over last 10 years, these 10 years. Okay, but what happened? This is the example of stress testing, stress. This is the example of back testing, back means comparing your immediate future, immediate past somewhere. But stress means if something which has not come up in last 10 years, if that comes up, then what? That's the use of Monte Carlo simulation. Monte Carlo simulation is used to check various unseen scenarios. So the answer over here is actual performance of the portfolio. It is compared with this, so it is back testing. So back testing is used for limited purposes, for normal trading conditions. Normal trading. I can't use backtesting for the extreme trading conditions. Okay, we call it a tail theory. Okay, we can't use it for the extreme conditions. Okay. Which of the following is used to determine the possible changes in the market value of the portfolio that could arise due to non-normal movements? Non-normal. Normal means what? I just gave you that example. Backtesting, normal. Non-normal means backtesting, stress testing, downside potential and duration. Backtesting, stress testing, downside potential and duration. Remember, downside potential means what? Downside potential means what? Now see here, you all guys will get confused between C and B. Okay? B and C you will get confused. Non-normal movement. So where do I use this, in which method do I use this non-normal movement? It is this. So this stress testing, this is the non-normal movement of this like COVID. So this is checked in what? Strictly backtesting is not the answer. Duration is not the answer. Okay, duration is totally different concept. Okay. So what is it? Stress or downside? Stress or downside? The correct answer is yes. The correct answer is stress testing. Remember, just now I gave you this meaning of the stress. What has not happened up till now? That's what is the meaning of this word non-normal movement. What has not happened up till now can happen, and that is used in stress testing. So in stress testing we use various scenarios now. Can this graph go up to this part or up to here? Can it go up to here? So what all scenarios can be there? That all scenarios are tested over here. Okay. So stress testing is the answer. And the last question for today. Which of the following techniques are covered by stress testing? Which techniques? By stress. Okay. Simple sensitivity, scenario, maximum loss and EVT, extreme value theory. 1 to 4 all, 2, 3 and 4, 1 and 4 only, 2 and 3 only. So which are covered over here? Think. Now the answer is simple. Stress testing covers simple sensitivity. Sensitivity means what? Fluctuations. Now these are these we are having again deep meanings in it. Today it won't be able to, I won't be able to explain you. It will take much time. Simple sensitivity, scenario, maximum loss, and EVT. EVT is extreme value theory. Extreme value theory means what can be my maximum extreme losses. Maximum loss means what? What can be my means no profit and all losses. You had the similar concept of maximum loss in your JAIB. That was called as, there were total 11 concepts, right? Remember them? 11 concepts in your accounting. Matching concept, then historical concept, then your entity concept, right? Then dual accounting concept, and one of them over there was conservative concept. Conservative. That conservative concept means this. Okay? It means that. It means this. So one of the approaches over there was conservative concept. Okay? So that conservative concept is similar to that of this maximum loss theory. So what is the option over here? Hi friends, welcome to Adda 24/7. We are in the Achiever series for BFM. Here we are covering all the important theory, numericals and objective questions. And remember, today we'll be covering the objective questions, very important ones. Okay? So don't miss it and watch the series till the end. Okay? Let's start. Okay. The dash isolates the short-term impact on the portfolio's value of a series of predefined moves in a particular market risk factor. The dash isolates the short-term impact. Very difficult question. Very difficult. Okay. First only it is a bouncer. Let me see how many of you can give the answer. The dash isolates the short-term impact on the portfolio's value for a series of defined moves in a particular market risk factor. Isolate. What is isolation? Isolation means like this. COVID. Suppose here, this is my market trend going on. Okay. And COVID happens. So this is one-off situation. This is isolation. So this isolation is done by whom? Simple sensitivity test, scenario analysis, maximum loss, and extreme value theory. So who does it? Think of it. Who does it? Yeah. Oh, I know many of you are typing this answer. Extreme value theory, EVT. Because why? I'll tell you the reason behind this. Why are you typing extreme value theory or maximum loss also? Some of you are typing. Because you see, simple sensitivity means simple. Simple. We all go by this English logic. Simple means simple. It will be simple something. Why will it cover this extreme something different? But the answer is different. The answer is the same. The answer is simple sensitivity. Simple sensitivity test is a test which can isolate. Remember, it isolates the portfolio's value of series of predefined this moves in a particular market. So simple sensitivity test is the right answer for this. Didn't I say it's a bouncer? First question itself was a bouncer. Today we'll be solving some numericals also. So that's why watch this till the end. Okay, numericals are still there. We'll be covering numericals. Okay. The dash, okay, next one. The dash specifies the shocks that might plausibly affect a number of market risk factors simultaneously if an extreme but possible event occurs. Might plausibly means what? That will definitely. Plausibly means definitely, surely, surely. These big words do come in your exam also. Number of market risk factors simultaneously means at once. Simultaneously means at once. At same time. I'll call it simple. Same time. Okay. So at same time. If an extreme but plausible event occurs, means what? What do you mean by this? See here. When COVID came, what happened? COVID. Few things happened. See here. First, health issues, health condition, deaths. Deaths were there. Health issues were there. Health. So all, it's always said in English, okay, that whenever the bad things come, they come at the worst time. So deaths were there. Then second was economy. Economy immediately went down. All your interest rates immediately went up. Bond prices went down. So economic problem. Then immediately third one, home. Isolation. Everyone had to sit at home. No work. Means no work means work was there except the bankers, right? Bankers had to work at that time also, isn't it? Bankers are the, what we call, Amar, Ashwathama. Amar whom hai, right? Don't you think so? So bankers were working at that time also. The dash specifies the shocks that might surely affect number of market factors at the same time if an extreme situation happens. So what specifies? Simple sensitivity, scenario analysis, maximum loss, and EVT, extreme value theory. So which one gives you the answer over here? What all scenes can happen? What all situations can happen? So who can give you this? Again, I am seeing many of you typing this EVT. No, EVT is not the answer. This is not the answer. So is it C, maximum loss? Maximum loss theory is different. That will be studying someday. Or that's why I say join the classes, paid classes, very lowest cost. Okay, join the classes. The answer is this: scenario analysis. Scenario. Various scenes. I gave you that hint. Various scenes. Number of market factors means number of market risk factors means what? All these are risk factors. Deaths, health, economy, isolation. There can be many. You can go on and on. Right? So we in scenario analysis, we consider various scenarios. If this happens, what? If all the three come together, then what? If two come together, then what? If there's the fifth one, then what? That is known as a scenario analysis. Very important parameter while calculating the, while we do the calculations for the various risk factors. Okay. So the dash specifies the answer is scenario analysis. Next one. The dash approach, see this, all of them we are covering, assesses the risk of the portfolio by identifying most potentially damaging combination of the moves of the market risk factors. So most potentially damaging, okay. So dash approaches the risk of the portfolio by most potentially damaging, means which can affect me the most. Highest, hit it where it hurts, right? Or hit it hard where it hurts. That's what is the logic. So most potentially damaging combination. So what will be the same? Now the answer will be what? Many of you might have guessed it, right? What can be the answer? Okay, I'll give you the hint. Either it is C or D. C or D. Now many of you might be thinking A was the first answer, B was the second answer. So now the answer will be C. So you might click C, but some of you might think reverse. That no. How can the answer be so simple? So the answer will be D. So most potentially damaging combination. The answer is C. C is the answer. Maximum loss. Okay, maximum loss is a combination. So here what do we see? All the 3, 4, 5 factors whichever was there, like the death happening in the COVID situation, the interest rates going up, then the countries facing the economic recessionary problems, right? People facing the isolations. All these came at the same time, and because of this, what all can be the impact on my economy? Total impact on my economy. So that is known as a maximum loss theory. Okay. The dash means, and the dash is the means to better capture the risk of loss in extreme but possible circumstances. Very simple now, isn't it? Now you say, sir, we know it. Move on, right? Move on. Move on. See here, the hint is also given. Extreme but possible circumstances. Extreme means extreme value theory. So see, look at this. Why did I cover these questions? because I wanted to show you all the four this methods. Okay, simple sensitivity, what is the use? Scenario, what is the use? Maximum loss, what is the use? And extreme value theory, what is the use? Okay, so that's why these four are of utmost importance, and these at least two of them are asked in the exam. Okay, Universal Bank had purchased certain bonds which it wants to sell now. Now, Universal Bank had purchased some bonds. So there is a bank which had purchased some bonds. Now it wants to sell. The bank expects some fall in the price of the bond. So now the bond is, let's say, might come down, the bond prices. Bond prices, no, what is this bond price and everything? Whenever I am in the bank, I'll have to purchase some bonds for my CRR, SLR, or even for my proprietary purpose. Proprietary means trading book. There are two books. One is banking book, second is trading book, isn't it? Okay, let me show you. Books, there are basically three books, not two books, but generally we call two: bank book, and second is trading book. Trading, okay, book, right? Bank book and trading book. So in bank book, what do I purchase? I do purchase the bonds for compliance purpose, CRR, SLR. What do I add in this bank book? I add the various banking activities in this bank book. Means whatever income I get from my banking business. Trading book means here I purchase the bonds for, we call it proprietary purpose. Proprietary purpose, we call it, right? So trading book, proprietary means what? For my own profit and loss, P&L. Own P&L means I buy some bonds, and whenever I feel the rate is high, I'll sell it. So that is for my P&L purpose. There is a third book called as merchant book. Merchant. But we generally, it's like that keeping the ledger of that customer. Means how many, let's say I'm having the customer Reliance. I'm having the customer Tata. I'm having the customer, let's say Airtel. So what all business, what all services I have given, what all products they have purchased from me, what all bonds I have purchased on their behalf. Understand this, what all bonds I have purchased on their behalf. Because that record is to be kept separate, because these bonds are not my bonds, these are their bonds. So that is known as a merchant book, where I keep the record of the merchants of my clients. Okay. But what is the answer for this now? Universal Bank has purchased certain bonds which it wants to sell now. The bank expects some fall in the price of the bond. Which of the following type of risk is the bank facing? Liquidity, market liquidity, asset liquidity, and credit risk. Very not difficult one. Okay, type. Yeah. So what is the answer? What do you think? Okay, let's look at it one by one. Liquidity risk. Liquidity risk means what? Nobody is ready to buy my bonds. Nobody is ready to buy my bonds. For example, if I give you the bonds of, let's say, which company? Some Kingfisher Airlines, Vijay Mallya's company, defunct long back, right? That defaulted. Suppose if I'm having some bonds of that, and I tell you, sir, please buy those bonds. Will you buy it? Liquidity risk. Nobody is ready to buy those. But here, what are they saying? That this expects some fall in price. It means there is no liquidity risk. It might be sold at a lower price. Market liquidity risk means, market liquidity means what? Is the market facing a cash crunch? Cash crunch means there's no money in the market. Nobody is ready to buy. Why? Because of some serious issues. Anything. The RBI might have raised the rates. Whenever RBI raises the rates, there's a liquidity crunch in the market. Okay, so there might be no money. So is it so? No, it's not, nothing given like this, that they are facing the market liquidity risk or something. No, means there is a RBI has raised the rates, or some problem has happened because of which there is no money left in the banking system. Nothing like that. So B is also not the answer. What about C? Asset liquidation risk. Yeah, that can be the point. Asset liquidation risk. Why? Asset liquidation means what? As my asset, specifically for my asset. What is my asset? The bond. Bond is also an asset which I have purchased. So this asset liquidation, I'm trying to sell it, but it is getting sold at a lower price. So that is known as the asset liquidation risk. So C is the answer. But what about D? Why not D? Okay, I have explained you all these terms. Let me explain you the last one also, credit risk. Credit risk is always of two types, remember. One is counterparty risk. Counterparty means we call it default risk, counterparty. And second one is country risk. Always remember, credit risk is of two types. Means two parts actually. Country risk means what? Your counterparty, suppose if you have sold some material to somebody, so that party might not be able to pay you because of what? Reason number one, the party itself is bad. It can happen. The party is bad. The party is a fraud. So that is a counterparty risk. But what about a country risk? It might happen that your party is in Afghanistan. Afghanistan, the party is good. But what does that Taliban says? No, 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 no. Don't give money outside. So that's why there is a country risk. Similarly, North Korea. Similarly, now Pakistan, Sri Lanka. What are these? These are all the country risk issues. All are, the funniest part is, okay, how many of our neighbors are facing the country risk issues? Name them in the comment section. How many of our neighbors are facing the country risk issues? I'll name them. Okay, chalo. Pakistan, yes. Sri Lanka, yes. Maldives is also a neighbor. Yes, that is also facing the problem. Nepal, again yes. Then which one? Bangladesh, okay, still it's okay. Still it's okay. I'm not saying it's very good. So all our neighbors are in the same line. Only India is standing tall over here, right? That's why we should be proud Indians. All of you should have a pride about India. Because in this so difficult situations, we ourselves are the ones who are just standing tall. Okay. So coming back. So the answer is asset liquidation risk. Got it? Okay. Now we'll be solving two numericals over here. 1 day VAR of a portfolio is 50 lakhs with 95% confidence. In a month of 6 months, assuming 125 working days, how many times or days the loss on the portfolio may exceed the value of the portfolio 50 lakhs? This question will be surely there in your exam. Okay. So 1 day VAR is 50 lakhs. 1 day VAR is 50 lakhs. Means, what is 50 lakhs? It means how much can I bear? If I am a bank, I can bear 50 lakhs, up to 50 lakhs if the loss goes, then I am okay. But I am very much concerned if the loss goes beyond 50 lakhs. So up to 50 lakhs, I have taken in calculations up to 50 lakhs. Okay, right? Above 50 lakhs, 50 lakhs, concern. Okay. So now the question is, how many days will it be above 50 lakhs? That's what we have to solve now. So what do you mean by this? How to solve this? See, this 95% confidence. What do you mean by 95%? What do you mean by percent? Percent means 100, right? Percent is 100. So 95% means what? 95% means out of 100 days, 95 days, my loss is within 50 lakhs. Within 50 lakhs. Okay. So out of 100 days, for 95 days, my loss is within 50 lakhs. So for how many days is it above 50 lakhs? If for 95 days, it is within 50 lakhs. For how many days it is above 50 lakhs? Answer in the comment section. Simple. First standard maths. Out of 100, 95 are within 50 lakhs. So out of above 50 lakhs is 100 minus 95. So 5 days. See here, out of 100, 5 days this loss is above 50 lakhs. So this is a concern for me. 50 lakhs, right? So this is a concern for me. Concern. Now in 100 days I am having 5 days. So what is the number of days given over here? In a period of 6 months, assuming having 125 working days, it's given 125 working days. It's strictly mentioned 125 working days. So don't consider this 6 months. Otherwise, what will you do? 6 months, sir. 6 months means 30, 30, 30 into 6, 180. So 180 days. But no, don't consider 180 days. It is given 125 days. So in 100, I am having 5 days as a risk part. See this. What will I call this? In 100 days, I am having 5 days as risk. Right? Because this is my risk. Up to 50 lakhs is no risk. Okay. So in 100 days, I am having 5 days risk. So in 125 days, how many days will I be having the risk? So this is a direct proportion. It will be more. Always remember the difference between direct and indirect proportion. In direct proportion, we have dn upon n, right? So I'll multiply this. So it will be 125 dn means denominator into numerator, right? Upon numerator. So 100. See, this is numerator. This is numerator. 125 into 5 cross multiply upon 100. So it is what? 125 5 is what is that? 500, 625 upon, so 6.25, 6.25 days. So this is my answer. For 6.25 days, okay, my portfolio will exceed, okay, my 50 lakhs for 6.25 days. Isn't it? This question comes for 1 mark. And if you know the basics here, I have taken here almost 3-4 minutes to solve this. In exam, it will take hardly 10 seconds. Why? Because you know it. If you know it, it's very easy to solve. 100 minus 95, right? Simple 5 days. In 100, 5 then 125, how much? How much? 6.25, right? Simple. A 5-year 10% semi-annual bond has a basis point valuation of 125. So yield has decreased by 5 basis points. What is the profit or loss due to this increase? Now, very, very, very simple. Let me write it. V simple. Third V also. You can write 5V also. V simple. But you must know it. Only then it is simple. Otherwise you don't know. You can't solve it. Firstly, you need to understand what do you mean by basis point valuation. Basis point value. What do you mean by this? Basis point value means the change in the price of the bond. Let me write it over here. BPV means what? BPV means what? Change in the price of the bond. Change in price of the bond. Okay? Change in price of bond. For what? For this 100%. So 0.01%. Look at it, 0.01% change in the rate of interest. Change in ROI. ROI means benchmark rate. Benchmark means, let's say repo. I'll give you a simple example as repo. For 0.01% change in the repo. So it's called as 100th%. Actual word is 100th. Means you divide 1% into 100 parts. Okay. So that way, that much percentage change in the interest rates or in the repo rate, if it happens, then what is the change in the price of that bond? That is BPV. So that's why you need to understand here there are 2 methods for market risk. One is BPV and second is duration method, modified duration. You need to learn. That's why I'm saying join the paid classes. Cheapest cost is it's available. Means it's less than the cost of your pizza. Okay, isn't it? So that's why join it. Okay. So coming back, what is the answer for this, everyone? Now I told you the meaning of BPV. So now give me the answer. What does it mean? What does the question say? BPV of 125 means what? If there is a 0.01% means 1 BPV change. 1 BPV means what? 0.01%. So if there is a 1 BPV change, let's say, change. Okay, then the price of my bond changes by, price of the bond changes by 125 rupees. Rupees 125. That's what is said over here. So now what have they given? If my BPV is decreased by 5 basis points, so now for 1 BPV I am having the price change of 125. So for 5 BPV I'll have the change of what? What will be the change? So it will be simple. 125 into 5. This proportion. So it is 625. 625. So that is my profit, isn't it? So this is my answer C. Remember 625, just multiply it. Okay. Now the problem over here is profit or loss. That is the question. Profit or loss, C or D? Now understand one thing. Okay. C, I gave you directly the answer because I'm doing this for many years. That's why I know it's a profit. Now I'll give you the logic behind this. See this. Whenever the interest rate falls, everyone pay attention. Whenever the interest rate falls, interest rate goes down, the price of the bond goes up. Price goes up. So whenever the price goes up, I'm in a profit. Suppose if I had brought this bond for 100 rupees, now the price is 105. So I'm in profit. I'll sell it, isn't it? So that's what the meaning is. What is given? If the yield decreased by 5 basis points, the interest rate, yield means interest rate. Okay. There are various names to the same word. Yield, interest rate, then YTM, asking rate, various. Inflation also some books call it. So that is also anything is called. Okay. Market rate. So the interest rate, yield or anything you call it decrease. So interest rate has gone down. So price will go up. So I'll be in profit.